Hello, I'm Peter Towers. Welcome to the Trades Charge Out Rate Calculator information webinar being presented by ESS BIZTOOLS. I hope you're having a wonderful day. We're going to be discussing the Trades Charge Out Rate Calculator that's been developed by ESS BIZTOOLS, and hopefully you will gain an appreciation of how this product package can be utilized by accountants and bookkeepers to guide your clients through this process, to make sure that they are charging appropriate rates and that there's some link between those rates and their business operations. They're not their competitors down the road that they've overheard discussions in a hotel somewhere and they've just tried to implement them, because there can be completely different circumstances at play. So tradies do need accounting assistance. They need far more than just an annual set of accounts and an income tax return. They need this assistance throughout the year, not just for one or two meetings, primarily being held to discuss taxation issues. The setting charge out rates should connect to the dynamics of the business. It depends on the team. It depends on their productivity. It depends on the amount of leave that they are receiving. It depends on how generous the owner of the business is relative to things like holiday pay loading, superannuation rates, leave, and so on. A targeted profit should be determined at the beginning of the year, and then a budget implemented to achieve that targeted profit. Now, the targeted profit could be based on a percentage of the calculated or agreed investment in the business. What's this business worth? What would your client want to receive for it if it was put up for sale? Or it could be a nominated figure, $50,000, $100,000, whatever. And then we can set out to take them through this process to show them what the charge out rates would have to be to meet the dynamics of their business. How many tradie clients does your firm have? Most accounting firms have some tradie clients. And my calculations, there's about 150 different tradie groups in Australia. And some of you may say there's more. There's a lot of them, different categories. There's a lot of potential clients. How do your clients set their charge out rates? Do they do what I said a little bit earlier? They listen when they're having a drink on a Friday afternoon and hear one of their competitors talking to someone about how much they charge per hour. That could be a set-up conversation. It could be based on completely different dynamics that apply to that other firm. I think there's an opportunity for you to assist your clients to set up their charge out rates utilizing this calculator. And then you could be talking to your clients about offering them services throughout the year, as one of our subscribers has done. When he first came and had a discussion with me, he told me he had 10 tradie clients. And a few of them were asking him about charge out rates. And he made some inquiries from other accountants and had learned that ESS BIZTOOLS had developed a tradie charge out rate calculator. He now tells me he's got 120 tradies on his books, and he's done no promotion, no advertising. It's been word of mouth within tradie circles. And basically what he's offering them is accounting services throughout the year. They produce monthly financial accounts. They compare the actual performance to what was included in the calculator, so they can fine-tune the results if they need be to get realistic charge out rates for the next month. If they were undercharging because the productivity percentages that had been used in the calculations were incorrect, well, that money's lost, but they've picked it up within a month of it occurring. And that's the crucial thing in all of this accounting advice to businesses, is to pick up problems a lot quicker than when they might be picked up on the traditional way of preparing an annual set of accounts. And there needs to be far more intense analysis of the metrics for the business. These productivity percentages are very important, and as are the other aspects of this system that I'm going to discuss in this discussion with you today. Now, we received a strong endorsement of the ESS BIZTOOLS charge out rate calculator a few weeks ago when Amanda Gascoigne, a well-known accounting industry mentor and coach, said, "I love the ESS BIZTOOLS trades charge out rates calculator." Amanda loves it because she recommends it to her group of accountants that she is mentoring, because it's a simple way for those accountants to become more actively involved with their tradie clients. And I would hope that viewers of this video will be able to do exactly the same. Amanda said there are significant opportunities to assist tradie business operators to improve their business by proactively advising them on the calculation of charge out rates. It's not the end of the story, of course. In lots of ways, it's only the beginning, but it's an important step to help your clients on this journey. So let's look at the key components of the tradie charge out rate calculator. Applicable labour on costs, and they do vary. I'm going to show you that in a moment. Wages and salaries being paid, the working hours, individual productivity percentage, overhead expenses of the business will all vary, of course. The value of estimated purchases for clients during the year. A lot of people forget this, but a significant number of tradies are buying things for their clients throughout the year because the client says, well, can you buy those light fittings? Can you organise the purchase of the windows? Can you help me buy the carpets? And I think your client's entitled to a markup on that purchase, because in many cases, the bill will come to your client, to the tradie. They've gone and used their account at Bunnings or any other type of product distributor, and they've bought the products. Obviously, they've got to pay that debt. They've then got to bill the client and perhaps wait a few weeks to get paid by the client. What's the targeted profit for the year? When we show you the calculator, you can see it could be a figure that's been inserted. You think the business is worth $450,000, and what rate of return would you like to receive? In the example I'm going to show you, we've used 20%. So obviously the targeted profit is set at $90,000. Now, you could have just as easily just typed into the calculator package $90,000 as the targeted profit. The system will allow you to do that, because some people will have different opinions as to what they think their business is worth, and they may have an idea of what profitability they'd like to earn. And then the system will be able to calculate for you the projected income to be generated by each team member. So this is the people on the payroll. What are they going to be able to be charged out at? Now, within a team, not everyone's going to be chargeable to the end client. The office workers may not be chargeable in the normal way of thinking, but if they're directly involved in a process, well, they could be given a chargeable percentage as well. And then we're going to have a financial forecast which will reconcile with the targeted profit. In other words, when we show you the calculation, the income, the direct costs, the overheads, final result, that final result will come within a couple of $100 of the targeted profit that we started with in the first place. So your client then has a document, have a manuscript to say, this is what we should be able to achieve for the year. There's a lot of other challenges, of course, that are going to be incurred. I've taken the opportunity then of alerting you to the 52-week business enhancement system, which ESS BIZTOOLS has developed, because I believe it's necessary that as accountants, we are supplying services to our clients throughout the year, daily, weekly, monthly, and then it's repeated again in the following month, daily, weekly, monthly, because this is how businesses operate. They don't just operate all around the year, then have a annual review and an annual set of accounts and a tax return prepared. That's not the reality. The reality is there's certain information that should be known each day, other things weekly, and a monthly set of accounts. So you could set up the system for the weekly recording of productivity percentages and productive hours being earned by the team. Now, I'm not envisaging that you as the accountant are going to be doing this, but you'd train someone within the client's office to monitor the time sheets, the records that have been prepared by the team members, so that the productivity percentages are known, and they should be getting compared to the budgeted amounts, which we're going to share with you soon, so that they can be compared to the targets, so that if the budget for a particular team member was set at 70% and they've only achieved 44%, some inquiries should start going up. Is why did it drop, that large drop down to that figure? Or is this permanent? And should we therefore be making a change to the charge out rate that applies to that person? It allows some rectification to occur very quickly, not months later, but problems identified. That may have been a one-off problem, but it may have been that the basic information that's been utilized within the calculator was not correct. So if we've done all this, we can then get monthly financial accounts. We can prepare individual performances showing chargeable hours and productive percentages. And we can review the assumptions made in the annual charge out rate calculator. And this is the process that that client that I was talking to you, or our member was subscriber was that has implemented, that I was talking to you previously about. He then offers this full program for the clients. So each month they know what their result was. They get a report saying, here's the actual hours that have been charged out. This is the percentage, and this is what we originally budgeted. These are the variances, and there always will be variances. The key thing then is for you to have a conversation with the client to determine whether there's a necessity to make some changes in the formulas that have been used in the calculator. It's giving your client the opportunity of fixing things through the year. So I'm now going to take you to a review of the ESS BIZTOOLS calculator. So to just bring that on, I'm going to find that in our system. So on the screen now, you have the first part of the charge out rate calculator. So we have the tradie charge out rate calculator prepared by ESS BIZTOOLS. I'm calling the business Sparky Enterprises Pty Limited, and we've done it on the 9th of October. We have and some instructions which you would work through. It's giving you an idea of how these calculators work, which we have developed. It's in Excel, and it explains the system for you. And now we're going to move into calculations of labour on costs. What we've established is some parameters for the calculation of on cost based on people who have similar on cost figures. So let me just explain. And we have 6 of these, and there's 6 in each classification. That gives us 36 different employees that you could have. I think for small businesses, that should cover it very easily. And over the years, we've never had anyone asking us for any more to be created. So we're starting off on full-time employees, permanent full-time employees. The manager's the first one we've put in. And what we're inserting is annual leave. So you can see across the chart here, we've also got foremen and office managers. And you notice the numbers we've given them, A11, A12, A13. Those numbers continue throughout the system when we go through it. So A21, A22, that's the foreman and the office manager. And then we go over into A3, the break up there, we've got tradesmen, clerical staff, and trades assistants who are on the same on-cost requirements. So you can understand how that's working. Annual leave, everyone's on 20 days. Now, the shift work allowance, no one's getting it. Now, the holiday pay loading, we have shown that the manager's not getting paid that, but the other two categories are 17.5%. Statutory holidays, everyone's getting the 10 days. Personal care, we've factored in 10 days for everyone. Now, superannuation, the manager's on a special arrangement. He gets 15% super. The foreman and office managers are getting 13%, and the normal staff are on 11.5%. The payroll tax we've calculated because there's a component of no payroll tax applied on the payroll, so it ended up about 1.9% for everyone. Work care, we've used a 4% rate. And then we've inserted training. So for the manager or professional development, 5 days, the foreman and office managers, 2 days, the general tradesmen and clerical staff, trades assistants, 4 days. We're in Queensland, we're saying, so the long service leave works out at 4.33 days, as it does for a number of the other states. The system then calculates, we insert, first of all, how many weeks of the year it's intended this person will work. So we're saying 52, 5 days. System then calculates, that's 260, that's the same right across. So it then goes through and calculates for us the annual leave, the statutory holidays, the training, and indicates that the net working days per annum of this person is going to be 215, 218, 216 days. The percentages are then calculated on holiday pay percentage, and the annualized on costs are then calculated. Now, my observation over the years has been that many tradies forget all about the labour on costs. And you can see what the percentages are here, 22.57, 21, 20.4. They're a considerable cost. Whether your client is going to put some of this money into a separate bank account, so they're building up the cash holding, that's up to you. But we're building it in here so that you should be making provision for it and incorporating that in the sales prices so that a fund is being developed. It would be great if your client could put that aside into a special account so that they've got it for some time in the future. We then had a couple of others. So we had apprentices year one, they got different training days. We were saying a year one apprentice gets 20 days training, and the apprentice year four got 10 days trading, and so that made some adjustments. We then have the permanent part-time employees. So we said we had some labourers and we had some other office staff, but were only coming in part of the time. So we've made provision for them. So what we're trying to do, instead of having some sort of blanket figure for on costs, we are calculating it through to make the whole system a lot more accurate, and it's calculating this total on cost percentage to be shown. And if you've got clients with casual staff, we've factored in some cleaners who will be the casual staff, and it's calculated their results. So hopefully you understand how all that works. Then we're now going to go to the calculation of labour budget. I'll just go back to the beginning. So the system's transferred across from A1.1 in the labour on cost, which was the manager. And you then insert in the yellow columns. There's only one of them, and the salary is 145,000. The system then does all these calculations, factoring in the labour on costs, and the hours paid for, because we've already told them, told the system the number of hours that's going to be paid for in the year. The leave's been calculated, and we've summarized the leave back in the on cost. So we have the net working hours. Then what you've got to do is talk to your client and say, well, what's the productivity percentage that you're going to budget for these people? This manager does do some work on the tools or on drawings, or on a basis that it can be charged to the client. So we're saying that's 30%. So the chargeable hours would be 490. Total paid was 1976. These are all the same because there's only one person. So what we're looking to charge this person out is 490 hours for the year, but at how much? We don't know yet. And then we go to A 2.1, which is the foreman. So we said the foreman was being paid 120,000, but we're saying there's two of them. So 240,000, same thing across. We're budgeting 50% productivity for those people, and we've calculated what the total hours should be. When A 2.2, we got the office manager. Interesting as to whether there will be a charge out percentage. So the client is saying, no, there's no charge out percentage. So we're not going to recover anything directly for that person. So in effect, that labour cost for the office manager has been spread over all the people who have been charged out as productive labour. And then we have the other ones that have been transferred in. They've all got those reference numbers, which facilitates you to go back to the labour on cost calculator back here. You go back and check who these people are. So first of all, we've done the permanent staff. Then we do the permanent part-time staff. Then we do the casual staff. So at the end of that, the system has determined the total labour cost, which is including on cost, of 1.91 million. The paid hours is 36,992. The recovered hours, or the chargeable hours, is 16,477. So we've calculated the productivity percentage on the total labour is 44.54. Productivity is probably a bit of an unfair word. It's the charge out percentage, because I'm sure the office manager and the clerical staff are also very productive, but we're assuming they're not being charged out. The next item you need to insert is, what's the profit that we're looking for in this business? We've said here that the business is worth $450,000 and the owner would like to receive a 20% return on that investment. So that's $90,000. You could have just inserted the 90,000 or another figure, 120,000, whatever the owner would like to achieve as the profit. At the end of the day, they may want to revisit that figure when they see what the charge out rates have to be, but that's part of this exercise. We then go to the budgeted overhead expenses. Now, I haven't filled this in, but I would suggest that you do so, because it becomes a budget. I've just sorted in the total for the year at $450,000, and we then move into budgeted materials. Now, this is an interesting scenario that occurs in a lot of tradies' businesses. How much money are they going to spend during the year in the business buying products for the client? The client says, can you go and buy the carpet? Can you go and buy the light fittings? Can you buy the stove that we want to install, and so on? Your client's estimated this could be $1 million worth a year. How much do they want to mark it up? I put in there 10%. Some people mark it up 15%, may even go higher, to cover the time that's spent in going and buying these goods and services. That might be done by someone within the office. Some businesses, of course, have a specialist employee that does that. So we're generating a profit of $100,000. Now, one of the key factors in why I'm suggesting monthly accounts are done is to make sure that these goods are actually marked up that 10%, because we're factoring in that we're going to earn $100,000 from that. Now, what are you going to do with that $100,000? Our system is saying you could elect to use 100% of it in the determination of the labour charge out rates, but you could have only elected to use 50%. In other words, you could have said, we are going to put $50,000 of this as pure profit. We want to keep that profit. You could have elected to keep the full $100,000 as pure profit. And what that would have meant, the charge out rates would be higher than what the calculator is going to show you shortly. And as much as I don't like doing this, I have included a write-down factor of 5%. I don't like write-down factors, but some people have them. So I put the 5% in so you can see how the system handles that. Okay, so the system then does the summary. The total labour, including labour on costs, and the reference numbers are shown for all these items, so you can see where they've come from. The total labour on cost is 1.9 million. The return on investment, the profit that your client's after, is $90,000. The overhead expenses were $450,000. So at that stage, we need to recover 2.4 million. But we're building into this $100,000 we're making from the markups on these external purchases for the clients. So we take that off, 2.3 million. And then we got the cost for this write-down, this 5%. So we're saying we need to recover 2.4 million. The system then goes through some basic calculations to calculate the base cost. You can sit down and work this through if you like, but we take the total labour cost for each of these people. The numbers continue, the reference numbers, so you know who we're looking at. The hours worked, the base cost per hour, which is calculated there, and the total chargeable hours that we're going to charge this guy out at. So the base cost chargeable hour is calculated. Now, this is just an internal calculation, but it's there so you can see it. The budgeted overhead, sorry, I went the wrong way there. We were on base time cost. We then do the base time costs. Then the business overhead factor. Now, the business overhead factor is calculated by the total cost of those base costs. Sorry, I'll rephrase that. The total labour to be recovered is 2.45 million. The base cost of the chargeable hours is 887. So it's an overhead factor of 2.763. In itself, that doesn't mean much, but goes into the calculations. So the calculations have then gone through and been worked out. And again, those reference numbers appear so you can follow who we're talking about. So the manager is applicable charge out rate is $248. We've rounded it under 50 cents down, over 50 cents up. So we're saying the manager would be charged at $248, the foreman at $205, the office manager at $170, tradesman at $152. Remember, these are not exact figures based on actual operating costs. These are figures that we've just inserted so you can see how the system works. And then we produce the proof. So again, with the reference numbers shown, the manager is going to be charged out at $248 an hour. We're saying that he will be able to charge out 490 hours. So the recovery will be 121,570. The foreman, there's two of them, will generate 339,000. The big income earner, of course, is the tradesman, 1.6 million, and so on. But the system has told us we will generate 2.57 million from the charge out. And then we have the budgeted profit and loss account. There's the 2.57 million we're going to earn from charging of labour. We're going to sell that material we purchased for the client at 1.1 million. That's the $1 million plus the 100,000 write-up. We got an allowance for some write-offs, so we're back to 3.4 million. We've got the material cost and the labour cost, which between them cost 2.9 million. We have a gross profit of 545,000. System tells us that's 16%. We got overhead expenses of 450. We've made a profit of 95,956. We set out to earn 90,000. It's in the rounding off of the charge out rates that's really caused the variance. But you can then sit down with your client and say, well, is that reasonable? And go back and look at the charge out rates. And if they say, oh no, we can charge out more than that, you just adjust the required profit. The profit might go to $150,000. Then you sit down and go through it again. The key thing in all of this, though, is to make sure that the productivity percentages in particular are in accordance with the budget. And that's why we're suggesting it's a good idea to prepare monthly accounts and really go through those metrics, looking at the number of hours and the percentage, what revenue has been earned. And if you find that there's variances, there could be legitimate reasons that weren't thought about or weren't even known about when this was calculated, you can do some fine tuning and adjust for the benefit of your clients. I should have asked at the beginning, if you have any questions, can you just type them into chat and we can have a look at them later on. For those of you who are watching this video at a later time, a time more suitable for you, if you come across questions that you'd like to ask me, please send me an email, peter@essbiztools.com.au, and I will get back to you. We now then